Good afternoon and welcome to this week's weekly macroeconomics session for Friday the 5th of June 2015. It's David here and sitting alongside me is Jeff Saffer, head of our Elite Investors Club. Welcome to you, Jeff.
Hello, David. Hello, everybody.
You've had a busy week this week. There's been a fair bit of news on the local market in particular, and we've got a few things happening around the world, particularly in the Eurozone, a few things happening in the US as well. So let's get stuck into things, but first, before we do, our disclaimer. And our disclaimer states that the content of this presentation or any other Elite Wealth presentation does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, or particular needs. So please consult your licensed advisor before taking any action based on any of the content contained herein. I think that should wrap that up there, Jeff. Let's get underway and have a look at some of the events that shaped the market this week. It's been a busy week in Australia. We've had the RBA cash rate on Tuesday, the first Tuesday of the month. We've had the release of our GDP. We've also had retail sales, which is an interesting figures there. We've had our trade balance come out, which we were commenting on before, Jeff, was a little bit of a disaster. We've got, importantly, non-farm payrolls in the US tonight, so we'll find out how that goes tomorrow morning when we have a look at the markets. We've also had some news out of China, an ECB press conference in the Eurozone. I know you've got a little bit of feedback about that, so let's reflect on the week that was. Jeff, you mentioned last time that the RBA cash rate, you felt very strongly that it was going to stay the same, and there hasn't been a change this time. We had GDP quarter on quarter coming in at 0.9% versus 0.7%. Importantly, retail sales, 0 versus 0.4%, which was the expectation. What are your comments on that, Jeff? What's happening in the retail sector?
Yeah, look, the retail sales number was a really big miss. That's a fairly disastrous number and is not a very good indication for the economy. The only thing I will say on that is that it's before the budget came out and the May rate cut. So perhaps I think next month you'll probably see a bit of a bump in retail sales. But that certainly is a particularly bad number. That came out yesterday, same time as the trade balance data, which was also a disaster, as you said, a very low number. The deficit was about almost twice as big as expected, and I think that was actually the biggest monthly deficit on record. Imports were up and exports fell quite a bit. So that's, both of those are particularly negative numbers. And certainly saw the Aussie dollar fall on those. You mentioned obviously that the cash rate on hold at 2%. To be honest, that wasn't an amazing prediction. That was pretty much a sure thing. What was interesting though is that at the end of the statement, the RBA said we kept rates on hold. And that's where we feel rates are appropriate for now, and we'll wait for more data to tell us where to go next. So the market was kind of hoping that the RBA would hint there's a few more that there's the chance of a rate cut coming, and the RBA didn't play ball in a sense, and they just said, no, we'll keep our cards close to our chest. So that really disappointed the market. That's probably been the biggest factor why the Aussie market struggled this week.
Seems to be a key attribute of people who are in charge of making their central monetary policy, etc., that they're fairly straight-faced, and that the press certainly looks for any hint of clue one way or the other as to future moves. And you mentioned before that Glenn Stevens certainly plays things with a straight bat. It's probably breaching ahead a little bit, but obviously next week Glenn Stevens is making an announcement. He's giving a press conference, or whatever you would like to call it. He's speaking. We don't quite know what the topic of that's going to be, but perhaps the market is waiting for suggestions next week as to some leads as to what might happen with interest rates in the future.
Yeah, I don't think the market should particularly hold its breath because Glenn Stevens doesn't let too much loose in his speeches. A recent one he did, him and some other governors of the RBA as well have sort of hinted that they're starting to doubt the effect of more rate cuts. in terms of stimulating the economy, and that probably all it's doing is pushing up share prices and property.
Yep.
So a few little tidbits have come out, but certainly you won't get you're not going to get loose lips from Glenn Stevens.
Yep.
What was interesting, you mentioned the other major data in Australia this week was GDP. That was the only one of those that really came out ahead of expectations. 0.9 versus 0.7, really strong quarter.
Yep.
The only problem with that is that almost all the growth came from mining exports.
Right.
So commodity exports.
Yep.
And not even mining investment. So not the mining industry spending money, but just shipping over more volume. So shipping over more and more commodities. And if you strip that out, it was actually a particularly bad quarter. Mining investment went backwards, private investment went backwards, and I would suspect that that next quarter's GDP is going to be pretty tough. In particular, trade balance is a good indicator of that.
Yep.
As well. So yeah, that was a bit of a furphy, I think. I wouldn't have taken that 0.9 as good news. It was actually, if you read into it, it's pretty poor news.
Yep. Okay. In China, there we had the manufacturing PMI, and we had the HSBC manufacturing PMI as well. And we were talking last week that the manufacturing PMI there, the first one, that's the Chinese government's read.
Yep.
Compared to the HSBC, which is more. What's the difference between those two? Just explain that again for us, Jeff.
Yeah, so there's a few. So what we've got in the PMI, and this is probably PMI is probably the most important piece of data out of China. It gauges factory activity levels, and essentially there's 4 releases a month just to make it confusing for you. You get about 3 weeks into the month what's called a flash reading, and it's like a preliminary early stage reading, and that's the most important one.
Yep.
And number comes out from HSBC. They do their own survey. Then there's the official Chinese number. Each of those do flash. So that HSBC flash one is the really important one because it's earlier in the month, and we trust HSBC more than we trust the Chinese government. So what we've got here, these numbers are what we call the final numbers.
Yep.
They wait till the end of the month, and they go, here's what the numbers are. And there's very rarely any major deviation from a week or a week and a half beforehand. So these ones are not all that important, and I suggested they would come out basically exactly on as expected, as they have.
Yep.
Those flash numbers are what really provide the surprise and drive the market.
Yep. Eurozone, we had the press conference there, and we've got a photo of a chap waving his hand. Who's the guy on the photo there, Jeff?
The Greek Prime Minister?
The Greek Prime Minister. And he's waving. I don't know whether he's waving nervously or whether he's happy or whether he's saying, "Don't worry, it'll be okay." A little quote there. The Greek authorities have informed the fund today, that's the IMF, the International Monetary Fund, that they plan to bundle the country's 4 June payments into one, which is now due on June 30. That's like a little bit like asking your children to repay you and them saying, "Well, I don't have the money right now, Dad. Can you give me a couple of weeks and I'll pay it all back at the end of the month?"
But I've got payday coming up on Thursday, and
That's right.
And Jimmy owes me $30,
Yep.
and at the end of the month I'll pay you back.
And if you could pay me for next month's ahead, and then I'll be able to pay you. Is that okay, Dad?
Well, it's pretty much what Greece has been doing for about 2 or 3 years.
Yep.
So all this is doing is just delaying the inevitable. I mean, they're going to struggle at June 30.
Yep.
All it really does is gives them more time to negotiate. It doesn't really change anything.
Yeah, and certainly this is something that's having a big impact on the markets right around the world at this point. A lot of volatility. The Australian markets come off pretty heavily. Some of the European markets are starting to falter as well. So it's certainly not without its impact, and I think all eyes are on what's happening in the Eurozone at the moment. So what we might do is go and have a look at a few charts just to see the impact of what's going on overseas at this point in time, and just to see where we are in terms of the beginning of the year. So again, we've talked about this a fair bit of late, the fact that our market had got off to a really good start at the beginning of the year, putting on close to 10%. And since then, the last month, our market has really capitulated. We were in a sideways range for a little period of time. We fell out of that sideways range, and now we've given almost just about all of what we accrued since the beginning of the year up until the close last night. So you'll see here from the beginning of January, the market put on around about 10%. Nice healthy start to the year. really boosting some super funds, etc. Since then, the market's come back around about 8% as of the close of yesterday. So a lot of those gains being given away. You'll see that our stochastic has gone from low risk into moderate. Depending on how we finish up the rest of this week, we may in fact move down into high risk territory. If we go through and have a look conversely at the other benchmark that we use in our portfolios, because we're trading US and Australian shares, is the S&P 1500. And this index from the beginning of the year has put on around about 2%, so about equivalent to what our market has done. Certainly at the beginning of the year it was underperforming our market, and you would have noticed that in your stock scans as well. But at the moment, just looking a little bit weak. Was trying to break out of a range which we talked about a couple of weeks ago. Not very convincing, and at the moment the market's really just sort of moving up and down, up and down, up and down. And I think probably what's happening in the Eurozone is having a bit of an impact on this market as well. It's still in low risk for the time being, and we'll have to see how tonight finishes up on the US market.
Well, certainly just looking at those two, I mean, both the Aussie and the US market are each up, as you said, about 2% so far this year, but it's been a lot more of a wild ride on the Aussie, whereas the US has been pretty steady.
Yep.
It's a little bit less volatility. Speaking of volatility,
yeah.
We mentioned last Friday China, which had fallen 6-7% in a day, and it's had quite a lot more volatility this week.
Yes.
I think you've got a chart of that as well.
I've got a few different charts here, Jeff, that we'll have a look at just for comparative purposes. I'm not too sure whether China's the next one on the list or not. This one's actually the German market, so I just thought we'd go around and have a look at some of the other international markets that have performed well this year. Obviously, the German markets, again, since the beginning of the year, are really performing very, very strongly. And from the beginning of the year, putting on around about 26-27% to its highs. Obviously, more recently, the German economy, if you like, has got a lot of weight to carry, trying to keep the rest of the Eurozone going. It's come off a little bit of late, so it's come off about 8% from its highs. But still, even at the beginning of the year, over the space of about 3 or 4 months, really putting on a nice gain there. And so just having an awareness of other markets and how they're performing is certainly one way to think about boosting the performance of your portfolio, or adding some further diversification at least, so you're not just restricting yourself to 2 markets. So that's the German market. The Nikkei here, this is the Japanese market. And again, the last couple of sessions we've talked about the Japanese version of quantitative easing and the impact that it's having on their market as well. So again, putting on 17.5%, nearly 18% from the beginning of the year. If that rate continues, then that market's going to be up close to 50% by the end of the year. Now, I'm not forecasting that, but again, it just goes to show that if you have some methodologies, some strategies that at least make you aware of movement in other markets, again, the diversification helps to smooth out the ebb and flow of the markets. That's the Japanese index. This is the one you were talking about, Jeff, the Shanghai index here. You can see from the beginning of the year to now, it's put on nearly 50%. That's a massive outperformance of just about every market in the world. The volatility of recent has been quite extreme. In fact, yesterday, I think at one stage the market over there was down about 6% or something like that, Jeff, and then rebounding and closing up very strongly. So even though this market has had its chances to go down, there's something in the wings here that is continually forcing it back up. So this is the sort of performance that you can really have as part of your portfolio if you have a methodology, as we've discussed, to help you become aware of these particular opportunities.
I mean, speaking of that, I mean, in previous webinars, we've looked at the Aussie market and we've looked at the US.
Yep.
Commented how, look, over the previous years, the US has outperformed, but so far, in most of 2015, the Aussie's been stronger.
Yep.
But even though the Aussies had on the whole, not a bad year, particularly up until sort of a week ago, it's nothing like the gains that we've seen in the Nikkei, in the Hang Seng, in the Chinese market, in the German market, in the Italian market. Many of these are up, like you said, 15, 20% so far this year. So it's certainly important. We've educated our members a lot over the years of broadening their horizons to look at US shares beyond Australia. Certainly a lot more opportunities over there, but this shows the importance of picking the right market as well. The US is up 2% this year. Some of these are up 15, 20, 50% almost. We've been talking about this, you and I, in recent weeks and months in terms of our ETF strategy. Obviously, that's the main thing that the strategy aims to do, to try and be in the right markets at certain times. And interestingly, the ETF model that we have been working on has been invested in Japan for the last 4 months. It's been invested in Hong Kong for the last 3 months. And also had some exposure to emerging Asia as well. You need to have some kind of system to know when to get into these other types of investments, because that can completely transform your investing and results. If you can get onto these kinds of runs. If the Aussie market's not working, the US market's not working, there's plenty of other markets out there.
Yeah, exactly. And we've just sent out an article recently, Jeff, in the newsletter, which you all should have got by now. Hopefully you've had a bit of a read of that, just outlining what are ETFs and the value of using them as an investment vehicle. There will be another article coming out early next week, looking at some of the different markets, some of the returns, and in fact probably the world's most famous investor, Warren Buffett, choosing to provide some advice to his trustee once he departs the world, I guess, for want of a better word. And those instructions were effectively for his trustee to invest in an index-based fund, so something like an ETF that tracks the S&P 500, low cost, and basically just sit on it for the next 10, 20, 30 years. So that's advice from the world's greatest investor, and certainly something, a theme I think that we can perhaps take a little bit of a look at in terms of managing our portfolios. Right, that's the market. So let's go and have a look what's on the agenda for this next week, Jeff. There we go. So next week in Australia, the guy there with his hand on the lectern, Glenn Stevens, he's got a lot of data coming out that he and his team are going to need to think about. We've got NAB Business Confidence, we've got ANZ Job Ads, home loans on Tuesday, so it'll be interesting to see what's happening in the housing market there. We've got consumer sentiment, so how our mum and dad, Mr. and Mrs. Joe and Joanne Citizen, how they're feeling about their livelihoods at this stage, and whether they're planning on spending any money anytime soon. Glenn Stevens is going to be speaking on Wednesday, so I guess the media there are going to be listening for any hints about what he might be forecasting or thinking about going further. Trying to read his body language there a little bit as well. The employment rate out on Thursday, so looking at employment change. In the US, we've got core retail sales. I'll get you to explain that in a moment, Jeff. We've also got consumer sentiment as well, so both countries, if you like, how their consumers are feeling. And then in China, we've got CPI, Producer Price Index on Tuesday, so both those numbers coming out. Industrial production on Thursday, and fixed asset investment and retail sales coming out on Thursday as well. I think it was last week or the week before, Jeff, in Australia we had fixed asset investment, I think it was.
Yep.
And that was disappointing, I think, those figures.
Yeah, that was disastrous. I mean, a little bit different. Ours is quarterly.
Yep.
Theirs comes out monthly.
Yep.
Look, theirs probably has a little bit more. It certainly has a major implication for them in terms of where they are in their phase of basically their economy cooling down a bit. But but back to Australia, like you said, it's going to be a big week. Business confidence will be an interesting one, obviously seeing the results of that following the budget.
Yep.
Job ads is a nice leading indicator. So the job ads is actually a good predictor of what's going to happen to the unemployment rate in the next few months. Consumer sentiment, we had a really big jump in the sentiment last month after the budget, so it'll be nice to see that stay up high. Glenn Stevens, as I mentioned, I don't think he'll give away too much. And at this stage, look, the unemployment rate has been generally drifting higher over the last 12 months and is expected to continue to do so. But we've had some pockets of strength over the last sort of 6 months, so it's not as dire as we've seen. Quite a few positive surprises there. In the US, in terms of core retail sales, so core just strips out some more seasonal things as part of the retail spending. Now, this is an interesting one. This is core retail sales and retail sales have majorly underperformed expectations for the last 5 months, really disastrously so. So until I see evidence otherwise, I'd expect it to continue to produce another poor result. The expectations are pretty low, but even that could struggle to match that.
Yep.
And of course, consumer sentiment, very important in the US. We always talk about this, that the consumers are a major part of the US economy. This is an interesting one. This consumer sentiment, which had been consistently building for basically 5 years, in the last 4 or 5 months has sort of tumbled and then rallied back up and tumbled. The index has sort of gone all over the shop. Last month was a terrible one. So I wouldn't be surprised. I'd say there's a better chance than usual of seeing a really good result that blows away expectations, just because it seems to be a bit on and off at the moment. And as I mentioned, in China, obviously industrial production and fixed asset investment give us an indication of activity in the Chinese economy, but these have been tailing off sort of systematically, consistently for the last few years, and I definitely expect that to continue.
So really, in summarising the week ahead, Jeff, more volatility by the looks of it, with news coming out of Australia that could certainly move our market either way. The data coming out of the US potentially having an impact on the way that Janet Yellen's feeling about there, and the thoughts about interest rates, and then obviously it doesn't take too much to be occurring in China to push our market either in the positive or negative territory as well. So get used to the volatility for the short term, I think. It would certainly be nice to see our market find some support over the next week or so and get back into positive territory for all our members out there, and including ourselves as well, who are invested in the market as well, Jeff.
Definitely. It'll be an interesting week again next week.
Awesome. All right, well, have a good weekend, folks. And during the course of the weekend, I will put together a watch list, and I will also do a recording of the weekly analysis session. I will be having Monday off. It's a public holiday here in Victoria on the Monday, but you'll be able to access all that material from the website. So just keep an eye out for the notifications of that.
And that's for ETC members.
That's for ETC members, absolutely. Yeah. All right, thanks for watching, and we'll send out the recording shortly. Bye for now.
Thank you.